Inexperienced traders may wonder what happens to options when companies like Amazon and Tesla announce stock splits. Will the sudden change in price mean a big gain or a big loss? Hi, I'm Barbara Armstrong, and this is Comment Below. We've had a few people ask, what happens to options after a stock split? A conventional stock split occurs when a company divides its existing shares into more shares. The number of shares increases, but the price of each share decreases proportionately so that the total value of the company's shares remains the same. Because of the underlying price drop, it may seem like options would suffer a big gain or loss, but it doesn't work that way. Instead, options on the stock that split are adjusted automatically. So if you have a position in those options, you typically don't have to do anything. However, it's still important to understand the mechanics. Let's start with an example. On March 9, 2022, Amazon announced a 20-for-1 split. In order to participate in the stock split, an investor must have owned a share by the May 27th record date. Each share became 20 shares as of the X date, the day the stock starts trading at the new adjusted price, which was June 6th. After the split, each share, all else being equal, was worth 1/20th of its pre-split price. When a stock split is planned, the Options Clearing Corporation, or OCC, determines options contract adjustments that may include the number of contracts, strike prices, and multipliers. Adjustments are made on a case-by-case basis, but there are typical adjustments that are the same whether you're dealing with calls or puts. For example, for a whole split like a 2-for-1, a 3-for-1, a 20-for-1, and so forth, the number of contracts is increased and the strike price is reduced by the same ratio as the stock price. The contract multiplier stays the same at 100. Let's look at an example. Suppose Amazon closes at $2,300 per share the day before its X date. You have a vertical put spread where you own a put with a strike at $2,320 and you sold a put with a strike at $2,300. On the X date, the stock splits 20-for-1, which means that for every one share investors own, they now own 20 shares, and the price of the stock is now $115 per share. Now, let's look at your options positions. Instead of one vertical put spread, you now own 20, but the strikes would be divided by 20 as well. The 2320 strike becomes the 116 strike, and the 2300 strike becomes the 115 strike. The options prices would change too. Options prices are set by supply and demand, so the theoretical values would be around 1/20th their previous value. An options contract that was worth $100 would now be worth roughly $5, and one contract would have become 20. The options multiplier remains 100, and it still delivers 100 shares of stock. The options Greeks should remain the same in the aggregate as they were before the adjustment. In other words, if you had one contract, but you now have 20 contracts, the 20 contracts together will act the same as the previous single larger contract. Delta measures the change in options price in relation to the underlying stock price. Delta won't change because the strike price and the stock price are changed by the same ratio. Theta is the relationship between the options premium and time. The theta per option will be 1/20th what it had been. But if you own 20 options, the math for the aggregate position will be the same pre and post split. The same goes for Vega, which tracks the relationship between implied volatility and the options premium. After the split, a 1% move in volatility will have 1/20th the effect on each option, but if you have 20 of them, it'll be the same aggregate exposure. However, not every stock split is so clean. An odd split like a 3-for-2 or a 5-for-4 is a little different. The number of contracts remain the same, but the strike prices are split by the same ratio as the share price. These alterations often result in contract terms that fall outside the standard 100-share contracts, which are called non-standard options. Option traders affected by a stock split should consider the following. First, pay attention to where the expiration date of your options fall in relation to the split X date. For example, Amazon set its split X date for June 6, 2022. Options expiring before then would still be based on the pre-split price, but anything after the X date would be adjusted to reflect the post-split pricing. Second, if you end up with an adjusted option, it's up to you to decide whether to hang on or liquidate. Non-standard options can have volatile pricing and low liquidity, which can make it difficult to exit. The same option may be listed twice with the same month and strike price, but a different symbol. The abbreviation ADJ also may appear in the description or elsewhere in the expanded options chain, among other minor changes. Because some non-standard options can have less liquidity, it may mean wider than normal bid-ask spreads that could cut into your gains or add to your losses. With this in mind, be cautious and make sure you understand the risks before adding to your adjusted options positions. Third, confirm the details of any split that may affect you. The OCC posts information memos about adjustments resulting from each stock split, so check the memo to be sure you understand the details. Once you understand the dynamics of a split, you'll likely find it to be pretty intuitive. Just make sure you confirm the details and are prepared for when the split occurs. And if you have any other questions, comment below.